Candlesticks are good indicators of what is likely to happen in the near future, with respect of the price of the currency pair. Many candlesticks are good indicators of what is likely to happen in the near future, with respect of the price of the currency pair. Many to happen in the near future, with respect of the price of the currency pair. Many patterns. Would you be able to choose the most bearish candlestick? Meaning, if you were to see this, let's say around a key level, which one would give you the most confidence in selling? Why see? The reason lie in the reading of the candlestick, and if done correctly, will save you lot of time in learning all candlestick patterns. If we take a look at what is happening, one by one. In A, we have our price opening here, the sellers are pushing the price lower, but then the buyers are pushing the price all the way up. The sellers are still in control as the price close lower, but this is a warning that there is heavy buyers pressure below. On B, the seller are in control and the price is falling and close below opening. While this candlestick seems to be the most bearish, they are not telling us much, apart from the fact that sellers outnumbers buyers. In C, however, the sellers got pushed back early on by the buyers, the price is then pushed back by the seller, not only all the way down, but even lower. This is a clear demonstration that the sellers are in control, and that they want to see lower price. It might also keep away further buyers at attempting to buy this level. Is the hammer. The hammer forms after a downtrend, when it reaches a support level. The candlestick has a small real body and a long lower shadow, at least twice as big as the real body. There is no, or almost no, upper shadow. The real body can be either red or green. The hammer candlestick formation is viewed as a bullish reversal candlestick pattern, that mainly occurs at the bottom of downtrends. When the high and the close are the same, a bullish hammer candlestick is formed, and it is considered a stronger formation because the bulls were able to reject the bears completely, plus the bulls were able to push price even more, past the opening price. In contrast, when the open and high are the same, this hammer formation is considered less bullish, but nevertheless bullish. The bulls were able to counteract the bears, but were not able to bring the price back to the price at the open. The long lower shadow of the hammer implies that the market tested to find where support and demand was located. When the market found the area of support, the lows of the day, bulls began to push prices higher, near the opening price. Thus, the bearish advance downward was rejected by the bulls. The hammer is an extremely helpful candlestick pattern, to help traders visually see where support and demand is located. After a downtrend, the hammer can signal to traders that the downtrend could be over, and that short positions could potentially be covered. However, other indicators should be used in conjunction with the hammer candlestick pattern, to determine potential buy signals, for example, waiting a day to see if a rally off of the hammer formation continues, or other chart indications such as a break of a downward trend line. But other previous days' clues could enter into a trader's analysis. The shooting star candlestick formation is viewed as a bearish reversal candlestick pattern, that typically occurs at the top of uptrends. When the low and the close are the same, a bearish shooting star candlestick is formed, and it is considered a stronger formation because the bears were able to reject the bulls completely. Plus the bears were able to push prices even more by closing below the opening. Hanging man candlestick formation, as one could predict from the name, is viewed as a bearish sign. This pattern occurs mainly at the top of uptrends and can act as a warning of a potential reversal downward. It is important to emphasize that the hanging man pattern is a warning of potential price change, not a signal, in and of itself, to go short. When the high and the open are the same, a bearish hanging man candlestick is formed, and it is considered a stronger bearish sign than when the high and close are the same, forming a bullish hanging man. The bullish hanging man is still bearish, just less so because the day closed with gains. Mirror of the hanging man pattern. The candle looks like a shooting star, but it appears on a downtrend. It occurs in a context of a downtrend. It consists of two candles, the first being a red small-bodied candle that is engulfed by a second green large-bodied candle. The green candle must have a lower low and a higher high than the red candle. It indicates immense buying interest. They exhibit extreme market sentiment. In other words, a bullish engulfing pattern tells us that the buyers have overwhelmed the sellers in the market, thus engulfing the entire previous day's open and closing prices. Conversely, a bearish engulfing candlestick pattern tells us of the sellers overwhelming the buyers, and thus indicative of a drop in prices. Engulfing candlestick patterns can be traded as a reversal candlestick pattern, when found at the tops or bottom of a short-term trend, and validated by support or resistance levels. When an engulfing candle is formed within a trend, they are to be traded as a continuation pattern. One thing to quickly notice. In order to obtain an engulfing pattern, price must drop or jump, creating a gap. It is therefore useless, like most technical traders do, to search for them in 5 minutes, 1 hour, 4 hours chart, and even daily. The likelihood of spotting one is where the price gap, and in Forex this happens on the weekend closure. Therefore, I would advise to look at weekly and monthly chart to try to find one. Bearish engulfing. It occurs in a context of an uptrend. It consists of two candles, the first being a green small-bodied candle that is engulfed by a second red large-bodied candle. The red candle must have a lower low and a higher high than the green candle. Morning star. It occurs in a downtrend, and consists of three candles. The first candle has a large red real body. The second is a small-bodied candle, red or green, that closes beneath the low of the first candle. It represents indecision at a major turning point. The third candle is a large green real body, that opens above the small candle, and closes above the midpoint of the first candle. Evening star. It occurs in an uptrend and like the morning star, consists of three candles. The first candle has a large green real body. The second is a small-bodied candle, red or green, that closes above the high of the first candle. It represents indecision at a major turning point. The third candle is a large red real body, that opens below the small candle, and closes below the midpoint of the first candle. Bullish harami. It is a two-candle pattern that occurs in a downtrend. The first candle has a large red real body and is followed by a green small-bodied candle, whose body is located within the mid-range of the previous candle. Bearish harami. Like the bullish harami, it is a two-candle pattern, but it occurs in an uptrend. The first candle has a large green real body, and is followed by a red small-bodied candle, whose body is located within the mid-range of the previous candle. White soldiers. It is a bullish reversal pattern that occurs in a downtrend. After several bearish candles, red, 3 consecutive large bullish candles, green, form. The second and third candles open above the previous candle's low, usually in the mid-range of the previous candle, and close above the previous candle's high. It indicates that the trend has changed, and the bulls have taken control. 3 black crows. It is a bearish reversal pattern that occurs in an uptrend. After several bullish candles, green, 3 consecutive large bearish candles, red, form. The second and third candles open below the previous candle's high, and close below the previous candle's low. It indicates that the trend has changed, and the bears have taken control. OJI. It's a candlestick that forms when the opening price and closing price are virtually equal. It means that during the trading day, the price moved higher and lower, and neither the buyers nor the sellers were more prominent. The currency pair traded up, and the sellers stepped in and traded low, and the buyers stepped in. The DOJI is often mistakenly referred to as a reversal candle. Actually, it only indicates indecision. It tells you that the number of buyers and sellers has become equal. However, they can tell you more or less information based on the length of the wick. Like in our test. DOJI star. It is a DOJI that forms in an upward trend, and that is followed by a red candle, indicating a change in direction. The uptrend is about to reverse. Prior to the DOJI, is a large green candle indicating that buyers are jumping in after a significant advance. The evening star shows inability to move higher, and the red large-bodied candle following confirms that the sellers have entered the market. Morning DOJI star. It is a DOJI that forms in a downward trend. It is preceded by a red large-bodied candle, and followed by a green large-bodied candle. It announces an oncoming uptrend. Continuation pattern. The first continuation pattern formation is what we call the triangle. Triangle patterns are easy to spot and provide good risk-reward opportunities. Traders can quickly know that a big move may be near, as well the profit objective, and the amount to be put at risk. Symmetrical triangle. The symmetrical triangle is mainly considered to be a continuation pattern that signals a period of consolidation in a trend, followed by a resumption of the prior trend. It is formed by the convergence of a descending resistance line and an ascending support line. The two trend lines in the formation of this triangle should have a similar slope, converging at a point known as the apex. The price will bounce between these trend lines, towards the apex, and typically break out in the direction of the prior trend. Ascending. The ascending triangle is a bullish pattern, which gives an indication that the price of the currency is heading higher upon completion. The pattern is formed by two trend lines, a flat trend line or key level, being a point of resistance, and an ascending trend line acting as a price support. The most telling part of this pattern is the ascending support line, which gives an indication that sellers are starting to leave the trade. After the sellers are knocked out of the market, the buyers can take the price past the resistance level, and resume uptrend. The descending is just the opposite. The flag pattern, usually taking place over few weeks or months. It follow this guideline. First, identify a strong trend, flagpole. Second, through the duration of this uptrend, eventually prices need to rest, and consolidate those gains. This price consolidation becomes the flag of the pattern. The flag of the pattern tends to be a gently downward sloping price channel for a bull flag, and the opposite for a bear flag. Additionally, this consolidation will retrace a small portion of the previous uptrend. If the retracement become more than 50%, it may not be a flag pattern. Ideally, we'll see the retracement be less than 38%. Since this is a continuation pattern, we look for prices to break higher, with a length equal to the size of the flagpole. The double top and double bottom are very common reversal chart patterns. The double top is a bearish pattern that occurs after an uptrend, while the double bottom is a bullish pattern that occurs after a downtrend. This means that when you see the pattern, you will then look for selling or buying opportunities. There are two highs formed, where the price has attempted to break through a resistance level twice before reversing to the downside. There is also what we call a neckline, which is considered the bottom part of the pattern. What is happening is that the buyers have attempted to push the price through a key level like here, but were unable to due to the sellers entering the market. There was a second attempt by the buyers, but they were unable to break through to new highs, because the sellers entered the market in force once again, and overpowered the buyers. Once it became apparent that the buyers were unable to push the price through the key level, the price then reversed to the downside, with more sellers entering the market. The price must break the neckline of the pattern, in order for it to be a valid double top pattern. However, you will usually find that I would enter the market on key level, and if pattern confirmed, I would only stay longer in the short. Unlike most trader that trade pattern, I do not pattern trade, but rather use the pattern in itself, to either increase target profit area, or get out of a position. It is unlikely that I will enter a trade only based on a pattern. Pattern is generally regarded as a reversal pattern, and it is most often seen in uptrends. After a long bullish trends, the price rises to a peak, and subsequently declines to form a through. The market begins to slow down, and the forces of supply and demand are generally considered in balance. Sellers come in at the highs, left shoulder, and the downside is probed, beginning neckline. The price rises again, to form a second high substantially above the initial peak, and declines again. Buyers soon return to the market, and ultimately push through to new highs, head. However, the new highs are quickly turned back, and the downside is tested again, continuing neckline. The price rises a third time, but only to the level of the first peak, before declining once more. Tentative buying re-emerges, and the market rallies once more, but fails to take out the previous high. This last top is considered the right shoulder. Buying drop and the market tests the downside yet again. Your trend line, for this pattern, should be drawn from the beginning neckline, to the continuing neckline. Volume has a great importance in this pattern. Volume generally follows the price higher on the left shoulder. However, the head is formed on diminished volume, indicating the buyers aren't as aggressive as they once were. And on the last rallying, the right shoulder volume is even lighter than on the head, signaling that the buyers may have exhausted themselves. New selling comes in, and previous buyers get out. The pattern is when the market breaks the neckline. Volume should increase on the breakout. The reversal wedge is identified by the followings. Prior trend. To qualify as a reversal pattern, there must be a prior trend to reverse. Ideally, the falling wedge will form after an extended downtrend, and mark the final low. The pattern usually forms over a 3 to 6 month period, and the preceding downtrend should be at least 3 months old. Upper resistance line. It takes at least 2 reaction highs to form the upper resistance line, ideally 3. Each reaction high should be lower than the previous highs. Lower support line. At least 2 reaction lows are required to form the lower support line. Each reaction low should be lower than the previous lows. Contraction. The upper resistance line and lower support line converge to form a cone as the pattern matures. The reaction lows still penetrate the previous lows, but this penetration becomes shallower. Shallower lows indicate a decrease in selling pressure, and create a lower support line with less negative slope than the upper resistance line. Resistance break. Bullish confirmation of the pattern does not come until the resistance line is broken in clear way. It is sometimes prudent to wait for a break above the previous reaction high for further confirmation. Once resistance is broken, there can sometimes be a correction to test the newfound support level. Volume. While volume is not particularly important on rising wedge, it is an essential ingredient to confirm a falling wedge breakout. Without an expansion of volume, the breakout will lack conviction and be vulnerable to failure. ABCD pattern. There is two possible ABCD, the bullish, and the bearish version. ABCD pattern is one of the greatest pattern, and probably one of the most used one. It is very specific, and that makes it one of the pattern traders' favorite. Moving now on to complex pattern, like the 3-drive pattern, bullish or bearish. The bullish 3-drive pattern suggests market potentially at its most bearish, or higher probability for market reversal. Typically offers excellent risk-reward ratio. Pattern failure suggests potentially strong bearish continuation move may be in progress. So even failure is useful. The 3-drives pattern is characterized by a series of higher highs, or lower lows that complete at a 127%, or 161.8% Fibonacci extension. The bullish version of the pattern can help to identify possible buy opportunities, and the bearish version can help to identify possible sell opportunities. As you can see above, the price makes an initial low at point 1, this is the first drive of the pattern. Price then retraces before making a new low at point 2, forming the second drive. This second low should be a 127%, or 161.8% Fibonacci extension of the first drive. The price then retraces once again, and makes a third drive down which should also be a 127%, or 161.8% Fibonacci extension of drive 2. It is this third drive that you want to pay the most attention to, as this is where you are looking for a long entry. You look to enter the market on the third drive, as this offers the most precise entry point, with the greatest profit potential. This will either be a 127%, or 161.8% Fibonacci extension. For a bearish 3-drives pattern, a short sell trade, simply invert the pattern, and your orders. A simple way of finding a profit target is by drawing a Fibonacci retracement from the very high of the start of the pattern, to the very low of the pattern, where the pattern completes the third drive. The take profit is the 61.8% Fibonacci level of this swing. The stop loss would be placed just below the 161.8% Fibonacci extension level of drive 2. The diamond pattern, which is a combination of two smaller pattern, a triangle formation, and an inverted triangle formation. Diamond pattern. The diamond pattern, since technical traders use this pattern to predict a reversal of an uptrend, a short position is taken when the price falls below the lower ascending trend line. In the general and the bottom price targets are usually set to be equal to the entry price,